Hello, everyone. Thanks for joining me. Should you take the pension lump sum or should you take the annuity payment? That's the question we're going to try and answer today as we look at a retirement analysis of Peter Parker and Mary Jane Watson. Stay tuned for the details. Thanks for joining me today. Today, we're going to do an analysis of Peter Parker and Mary Jane Watson. Peter is retiring from an energy company and is now facing a decision on whether to take the pension lump sum or the annuity option when he looks at his various benefits. Peter is 62 years old. Mary Jane is 61. We think Peter's going to live to about age 85. Mary Jane, we think she's going to live to be 90. At his full retirement age, Peter is going to get Social Security of about $36,000 a year. We're assuming that inflation is going to be about 2.5% on their expenses throughout this analysis, and that his joint pension at 65, age 65, is $80,000 a year. And the lump sum equivalent for that age 65 pension is $1.5 million. Peter and Mary Jane have saved up $1 million in their 401k, and they'll be taking that into retirement. So the question is, should they take the lump sum or should they take the annuity? Let's have a look at the analysis. Here's a quick overview of what we're trying to figure out today. We've got Peter Parker here, age 62, Mary Jane Watson, age 61. They know that they can get a joint pension income of about $80,000 a year by taking the annuity at age 65 for Peter. Or they could take a $1.5 million pension lump sum immediately. We're estimating that their living expenses are about $113,000 a year. And so the question is, which one of these two options for their pension should they take? The first step in looking at this problem is figuring out what kind of portfolio to give them. So we've given Peter and Mary Jane a fairly standard moderate aggressive portfolio. And what that means is the investment portfolio for the $1 million 401k is going to be 64% stocks and 36% bonds. This decision winds up being a key input into the analysis because if they take the lump sum, they're going to be able to invest that money and watch it grow, as opposed to taking the annuity, which will pay them money each year. Now, the nice thing about the annuity is that it's mailbox money. You're going to get $80,000 a year until the end of Mary Jane's plan, until the end of her lifespan. That's good. That's the good news. The bad news is that it will not go up with inflation. So we're going to be inflating their expenses by 2.5% per year. And by the way, inflation also is a tailwind for certain types of investments like stocks. So we tend to see portfolios do very well over long periods of time in inflationary environments. But let's look at what the data actually says when we crunch these numbers. One of the things that we like to do is called a Monte Carlo analysis. And essentially, we're randomizing the rates of return on the portfolio. In one case, when Peter takes the pension annuity, it's going to be on the $1 million 401k savings going through the end of Mary Jane's plan. On the other, if he takes the lump sum, the 1.5 million lump sum, Mary Jane and Peter Parker will have $2.5 million to live off of through their retirement. And so we want to randomize the rates of return to see how does the spending affect the probability of success. And you can see here that it's very, very close. The pension annuity gives you a 79% likelihood of success. This is spending the same amount of money, the same $113,000 per year through retirement. And by taking the lump sum, the probability actually goes up a little bit. The big difference, of course, is the amount of money that's left over at the end. You can see here this number is the real expected value of the portfolio at the end of Mary Jane's life. So Mary Jane is going to outlive Peter Parker. And because she's getting the annuity, there's fewer assets to grow over time. But if they take the lump sum and invest that money, at the end of Mary Jane's lifespan, there will be $1.6 million. Let me walk you through how that works. So down here, I have something called, I call it the Blue Angel chart. It's a depiction of the portfolio during the couple's lifespan. Now, this is assuming that we're taking the lump sum. And so this dark blue line here is, of course, the median value of the portfolio. After Peter retires at age 65, he takes his lump sum distribution. And you can see as we go forward in time, there's uncertainty regarding the stock and bond returns. They might be above average, they might be below average, but this solid blue line is assuming we get average rates of return on the portfolio. One of the reasons we run this Monte Carlo is that there's a possibility that we get below average returns on stocks and bonds over the course of this 30-year time frame. And so actually what we're trying to figure out here is if we want an 80% likelihood of success, what is the minimum or the maximum amount of spending that we can have, and that's the 113,000 per year, and still have an 80% likelihood of success. Another way of looking at this is saying that 80% of the time, stock and bond returns will exceed what we're assuming down here for this $113,000 a year spending. So odds are Peter and Mary Jane will be able to spend more than their $113,000 per year. But today, right here at retirement, when we're trying to decide which option we want to take, looking out 30 years, 113,000 is the safest amount of money that they can spend and have a 80% likelihood of success. Odds are, if we get median rates of return, Mary Jane will pass away with 1.6 million in the bank. If they take the pension annuity, they will also be able to retire safely, but there'll be less money in the bank because there's less money to invest up front through the course of the retirement. Now, if we get above average rates of return and we don't use any of these numbers to build our retirement analyses, but they're always interesting to look at, is that the size of the portfolio will actually be much larger than where it is today. Now, we can't bank on that. We can't spend that. What we want to do is figure out how much we can spend safely over the course of a 30-year retirement, and 113,000 is the number. Where is their income going to come from? Now, in these slides that I'm going to show you, we're assuming that they're taking the lump sum. That would be our recommendation based on the terminal value of the portfolio at the end of Mary Jane's life, and also based on the slightly higher probability of success. So as we go through these slides, you can see in the first 10 years of retirement, rather first 8 years of retirement from age 62 through age 70, Peter and Mary Jane are going to be drawing on their individual retirement account. They're going to be drawing down that spending. Now, why would they do that? Well, it turns out if you wait to take your Social Security till age 70, the government rewards you for that. They reward you by about 8% per year, meaning for each year that you delay taking Social Security, your benefit will go up by 8%. Well, that 8% increase carries out through the rest of your life. So the rest of Peter Parker's life and the rest of Mary Jane's life. And you can see here that Social Security is a significant contributor to their income as they go through retirement. Now, one of the things to note here is at this point, which is where Peter dies and Mary Jane continues living, once Peter passes, Mary Jane will assume, meaning she'll get the primary beneficiary's higher benefit. So if you take that Social Security early or if you take it at the full retirement age, there's nothing wrong with doing that. But if you're married to a younger spouse and she's going to outlive you, remember she's going to receive your primary benefit after you pass away, and her spousal benefit will also go away. So the spouse is going to assume the primary beneficiary's benefit. Good to think about. Can we quantify that increase in Social Security? And the answer is yes. By delaying taking Social Security, Peter and Mary Jane will actually increase their retirement analysis or their wealth throughout Mary Jane's life and Peter's life by about $122,000. Here we can see that graphically. These gray bars are Mary Jane and Peter taking Social Security at the full retirement age at 67. But here you can see these blue lines are them delaying taking Social Security till age 70. Peter's age 70, and you can see they get a higher benefit all through the plan. And then after Peter passes, Mary Jane also gets a higher benefit than if they took it at the higher rate. Now, of course, if you don't live to these long ages, you don't get as much money. But this winds up being a hedge against longevity. Is there a break-even age? Yes, for this couple, for Peter and Mary Jane, the break-even is at about age 84, which means that if Peter lives beyond age 84, he's going to get more money from Social Security than if he took it at the full retirement age. And the same thing for Mary Jane. So it's age 70 is the recommendation for taking Social Security. And the reason is they'll get an extra $122,000 over the course of their lifetimes. One of the things we did in this analysis was run a stress test on a variety of scenarios that many people are concerned about. So here you can see we have the baseline assumption, the 80% likelihood of success, retiring at age 62, taking the pension lump sum at age 65, and Peter living till he's age 85, and Mary Jane living until she's age 90. An immediate market drop of 20% does take the probability of success down slightly, but not that much. And as you look across all of these scenarios, higher taxes, Social Security cut, unexpected longevity, unexpected inflation, unexpected healthcare expenses, every one of these winds up being a slightly lower probability of success, but not dramatically so. So for Peter Parker and Mary Jane, if they take the lump sum, we are actually not too worried about them being able to spend their $113,000 in today's dollars throughout Mary Jane's life. Here is the final part of the analysis, and this is a cash flow summary that pulls together all of the key variables that we've been trying to analyze and get our hands around. Here on this page, what we're showing on the left group of columns are the cash inflows, and on the right group of columns, the cash outflows. So what kind of cash outflows? We have their annual living expenses, any special goals they have, their tax payments that they may owe on IRA distributions and other income. We have their total outflows. Here on the left side, you can see the cash inflows, whether it be income flows from salary or Social Security, planned distributions from the IRA. All of the incomes are aggregated here into the total inflows column. And so here on the left side at age 70, we can see Peter and Mary Jane beginning their Social Security income. And down here at age 75, we can see he's beginning to take some RMDs. But what's most interesting at Peter's age 75 is that the sum of their Social Security and their RMDs wind up exceeding their income requirements. And so the net flows from the portfolios is actually positive. So they're going to begin building up an after-tax balance in the portfolios. Now, this is, of course, assuming that they get average rates of return on the portfolio and not below average rates of return, just as an FYI. And so you can see that's what we're looking at as we go through this analysis. All the way down here at the bottom, we can see Peter is passing away at age 85, and there's a natural step down in Social Security because Mary Jane will lose her spousal benefit, but will assume and receive the primary benefit that Peter was getting. And we can see that she lives on till age 90. So I hope that answered the question for you. Can you retire at age 62 with $1 million and a pension lump sum decision at age 65? The answer is yes. Our recommendation would be to take the lump sum distribution at age 65 for a slightly higher probability of success than the annuity. You can retire and take the $80,000 annuity at age 65. The key difference between the two scenarios here for Peter Parker and Mary Jane Watson is that taking the lump sum leaves the estate more money if we get average rates of return on the portfolio over a 20, 30-year period, as opposed to taking the annuity, which is going to leave the estate less money at the end of the plan, but have about the same level of risk. Thank you very much for joining me today. I hope you enjoyed this presentation on the pension versus lump sum decision for Peter Parker and Mary Jane Watson. Thank you very much. And if you'd like us to visit with you to talk about your situation, just give us a call at that phone number below or reach out to us at our email address. Thank you very much. If you found this analysis helpful, please hit that like and subscribe button down on the bottom or give us a call. We'd really like to hear from you. Thank you very much.